Thanks for clicking! The Canadian Real Estate Association, the CREA, has released Canada's real estate data for the month of November, showing a real estate market that is better than last year's 15-year low. Or, as the media puts it, real estate sales are surging. And the news comes as the Bank of Canada has recently delivered another 50 basis points in rate cuts, with CREA world-renowned economist Sean Cathcart here to tell us the implications.
Right. So the spring market part's pretty much guaranteed.
Thanks, Sean. But it's not just Sean Cathcart telling us what a great big real estate market we're going to have next year, with the Financial Post engaging in a number of analysts to tell us about the cuts' impact on the housing market, including Royal LePage CEO Phil Soper, who said that buyers will feel a sense of urgency to act before affordability erodes. Yep, according to the Financial Post, the head of a real estate brokerage whose sole job is to generate sales is in Analysts.
My daddy wouldn't tell me anything that wasn't so.
Do me a favor, we're all going to be gathering at various family functions over the next few weeks. While there, tell your family you listened to your car analyst, the salesman at the dealership, and made the second biggest purchase you'll ever make in your life, and then come back and tell us all what their reaction was.
Okay, Eddie.
So what I want to do today is go over Canada's real estate data for the month of November, take a look at what the CREA had to say about the market moving forward, and then discuss some of the interest rate outlooks for 2025 being put forward by the analysts. This is going to be my last video of 2024, as I will be going on holidays until January 8th.
That's awful.
I do want to wish everyone a very Merry Christmas, Happy Holidays, Happy New Year's, etc. I've greatly enjoyed going over all of these updates with you throughout this year, and I'm very, very much looking forward to seeing what 2025 has in store for all of us next year. Make sure you click like and subscribe if you want to get all of those economic updates, but for now, let's get into this data. Onto the data. First up, Canada's benchmark price. The benchmark price, if you remember, that's the price of a home that represents the most popular set of features, which was up in November. Canada's benchmark in October was sitting at $719K, and that jumped up to $723 in November. So the benchmark price up about $4,000 since last month, but still down about $8,000 since this point in time in 2023.
You're so good at your job.
In the market, says the crystal ball himself, the CREA's Sean Cathcart, is really heating up.
Home sales were up again in November, building on October's surprise big jump. Sales were up 2.8% in November compared to October. And at this point, they now stand a cumulative 18.4% above where they were in May before that first interest rate increase. So that's quite a bit.
And that's a really weird way to put it, though he's not wrong. Sales are indeed up substantially from May. In May, they were sitting at 37,600 and are now sitting at 44,500, though that really says much more about the weakness of May rather than the strength of November. Ideally, we wouldn't compare November to May, we would compare November to other Novembers. How many sales that we should have seen for this month compared to the number of sales that we actually did see, though that would only show a 3.75% increase from the average November. Sales are definitely up for the average year, what we would usually expect to see in November, but they're not up by all that much. In fact, if we took out the COVID years, they're really where they should be for all of the Novembers that we've seen since 2007. And, not to pile on, but if the market was as strong as is being purported by all of the analysts, technically we would want to see even more sales, as Canada has a much higher population than it's had for the previous 17 years. Regardless though, sales are up, and the CREA is arguing that this could be a precursor, this could be indicative of a strong market set to take off in spring of 2025.
Right. So the spring market part's pretty much guaranteed.
And this argument's obviously been echoed by thousands of TikTokers, no doubt, and of course their fearless leader, Phil Soper, the analyst.
What would you say you do here?
But the argument was in fact made by Phil Soper, that buyers would be piling into the market, feeling a sense of urgency to act before affordability erodes, meaning buyers would be piling into the market before they got priced out. The literal definition of a FOMO argument disguised as an analysis.
What would you say?
But that doesn't mean that Soper is wrong, especially this time around, as if buyers are piling in, they're not doing so because interest rates are dropping, because they're really not. In the aftermath of the Bank of Canada's rate cut announcement, bond yields which dictate the path of fixed rates, actually shot up, now up 15 basis points since that announcement last week. In fact, yields are up even higher than they were way back in September, 3 months and 100 basis points worth of cuts ago. Back then, a 5-year fixed insured rate from RBC was 4.64. Fast forward 100 basis points worth of cuts, and it's now sitting at 4.59.
Life will never be the same.
So, if buyers are going to be piling into the market, and they're not as of yet, but if they are, then sober is not wrong. It's due to a worry about being priced out, not actually due to the cost of borrowing dropping, because it's really not. And if this sounds familiar to everyone, it should, as we saw it in February of last year, when the headlines read, home buyers in Canada are so frenzied they won't wait for rates to go down. Shoppers seek to jump in before pent-up demand unleashed. A Toronto realtor noted in February that there was a renewed sense of urgency among home buyers, and a mortgage broker in Vancouver warned of busy markets and multiple offers in Vancouver and Toronto. And then, of course, the benchmark price did this in Toronto in 2024. It must have been just those buyers that particular realtor knew, because I'm sure that realtor had actually talked to all these people that were frenzied.
Really?
Really?
And like I said, even between now and last February, rates aren't all that different. A decent 5-year fixed insured rate from RBC last February was 5.14, compared to the 4.59 that we have right now, a difference of about 50 basis points compared to the 175 basis points worth of cuts that have been delivered by the Bank of Canada. And again, and not to belabor the point, but fixed rates are not all that different. Whether or not the usual suspects don't realize that because they don't know the difference between short and long-term rates, which I know for a fact is true in many cases, or the usual suspects do know that and are pushing the narrative anyway, which I know is also true in many cases, the result is still the same. Despite the bank's cuts, rates are not all that lower. Fixed rates anyway. With that said, variable rates definitely are getting better, with prime now sitting at 5.45. It won't be too long before variable is comparable to that of fixed.
And you'll never have to worry. All right?
Even the Financial Post's Rob McClister, who has been a massive variable cheerleader for all of this year, is noting that risks are abounding on the adoption of these floating rates. With inflation ticking higher as of late, stimulative policies coming out of the United States, and potentially higher yields and short-sighted government spending sprees, all presenting risks that the central banks could have to pause on their rate cuts, or even hike.
This came out of nowhere.
So that very well could end up being the choice. Buyers faced with still high fixed rates in that 4% range, or rolling the dice on variable rate mortgages, which I'm not exactly sure that buyers pile in on floating rates, given that we're still dealing with the fallout from the last variable binge that we saw in 2021. So we have fixed rates that aren't really falling, and we have variable rates which are continually getting better, will probably continue to get better and more attractive over the coming 6-12 months ahead. But I'm not exactly sure the extent to which Canadians are going to pile into those, given the bitter taste that are still in the mouths of a lot of Canadians who did the last time. Is the real estate market going to take back off if fixed rates are still above 4%, meaning buyers have to qualify at 6+%? Can these prices, which are still massively elevated from pre-pandemic, be supported at 4+% interest? Well, the 30-year amortization on insured mortgages is definitely going to help, but it's not clear as of yet that that will be enough to push up prices to the extent to which is being argued by these analysts. These analysts aren't giving us any data. These analysts aren't saying, well, the last time amortization increased by X amount, we saw a correlation with prices increasing by Y amount. We're not getting any of that type of data, no historical comparison, just the argument that, well, amortizations are increased, interest rates are low, which they're not, and therefore the market's going to the moon, which, as we saw last year, sometimes just does not play out. With that said, as we saw with Toronto, as we saw with London, there's still a lot of inventory sitting on the market, And all of that inventory is not going to get sapped up in December.
It might.
So if you do plan on buying in the spring, there is still some time to watch which way the wind is blowing. Chances are, I never say 100%, but chances are you're not getting priced out by January 1st. With that said, we will obviously continue to track Canada's real estate market throughout 2025 on this channel. Click like and subscribe if you want to get those updates, and thank you all so much for watching.